If you've sat down to build an investment portfolio and you've asked yourself the question, which type of company do I actually invest in? Not which specific stock, but a type of company. Do I invest in growth companies, value companies, large caps, small caps, technology, healthcare, maybe energy or consumer staples? And how do I know which category of company is right for the environment that I'm actually investing in? And how do you avoid being heavily invested in the wrong sector at the wrong time? Well, this video is going to give you a clear rules-based answer to that question, because by the end of this, you're going to understand the stock market is actually divided into two types of companies: cyclical and defensive. You'll know exactly which type of environment favors each one, and you'll see how to use the macro data inside the AI app I'm going to show you to position your portfolio in the right sectors at the right time. Not based on tips or not based on headlines from last week, based on the same framework professional investors use to rotate capital across sectors for decades. Now, before I give you the framework, all right, I want to explain something that most retail investors never fully grasp. And that is the reason why some portfolios that look perfectly positioned in one economic environment can completely fall apart in another. And it's because most investors are choosing a stock to invest in based on the company itself. They're looking at the product, the brand, but they're never asking a more important question: what does the economic environment do to this company's earnings? Because the reality is, not all companies' earnings respond to the economy in the same way. Some companies, so we're talking about cyclical ones, their earnings are deeply tied to economic growth. So if the economy is expanding, okay, and consumer spending is rising, their revenues rise, and these stocks perform well in that environment. But if the economy is contracting and consumer spending is falling, their revenues fall, and these stocks get killed in that environment. But then we have other companies that are defensive companies, and their earnings are far less sensitive to the economic environment because people need their goods and services regardless of what the economy is doing. So think healthcare, utilities. You still pay your electricity bill in a recession. You still buy food, medicine. So these companies' earnings are far more stable. So they'll outperform cyclical stocks in downturns and recessions. So most investors make the mistake of building a portfolio without considering the economic environment they're investing into. Okay, so they may think, okay, I'm well diversified. But if the portfolio is heavily weighted to cyclicals and we have a slowdown or contraction in the economy, they will experience far more pain than they realize. And if their portfolio is defensively positioned, going in an economic growth phase, they're gonna underperform in this environment. So the economy is the context we need to always focus on, but most investors never focus on the context before they build the portfolio. Now, over the years, I've personally educated thousands of investors in my private investment communities. I've spent thousands of hours studying macroeconomics, capital flows, and the relationship between economic cycles and sector performance. And one of the most important things I've seen across decades of market data is sector rotation. So money moving between cyclical and defensive positions based on the macro environment. And by learning this early is one of the most important decisions any investor can make. Otherwise, you're basically investing in the dark. So getting the macro environment right and then positioning correctly into certain sectors is far more important to your portfolio performance than buying any individual company. So in this video, I'm going to show you how to use the macro portfolio app that I built based on AI, and it's going to tell you where the economy is going next. And then I'm going to walk you through the defensive and the cyclical sectors so you know exactly where to invest into based on the environment that we're in now and where we're heading. Okay? So let's get into it. Okay, so here's exactly what we're going to be covering. First of all, there are two types of companies in the stock market. We have cyclical companies and we have defensive companies. Now, what separates these two types of companies is their sensitivity in their earnings to the underlying economy. So companies in the cyclical sector, their earnings are deeply tied to economic growth. So in an environment of economic growth, companies within the cyclical sectors are going to outperform. And this is why investors, during times of economic growth, which is happening the vast majority of the time, they're heavily weighted in their portfolios towards cyclical stocks because this is when you're going to get bigger returns in your portfolio. Okay. And then we have defensive stocks, and their earnings are less tied to economic growth. So the sensitivity in their earnings are more stable. So investors position themselves less in the defensive sectors during economic growth because their earnings are not going to be as cyclical, and the returns in these types of companies are not going to be as high as the cyclical sector stocks. Okay. Now, the economic environment that we're investing in is going to determine the types of companies you want to hold in your portfolio. So if we're going through economic growth, you're going to want to be more weighted towards the cyclical stocks because this is where you're going to get your big outsized returns. And capital rotates into the defensive sectors when there are economic slowdowns. So it's the macro environment which is really going to determine whether you're positioned more heavily into defensive stocks or cyclical stocks. And we're going to break this down in a lot more detail as we go through the video. Then thirdly, I'll be educating you in this video how to use beta as a measurement to know exactly how sensitive a company's earnings are to the economic environment. And beta basically becomes your tool to identify if a stock is highly cyclical or highly defensive. So this allows you to invest with precision when you're buying specific stocks. So for an example, this company, its beta score is 5, which basically means for every 1% move in the S&P 500 and the US major benchmark stock market index, which is the S&P 500, is highly tied to economic growth. So if the S&P moves by 1%, this stock is going to move by 5%, which means it's highly cyclical. Its earnings are very sensitive to the economic environment. So this type of company, if we are going for a period of economic growth and their earnings are growing and revenues are growing, this stock you could expect to really outperform. And it's the stocks with the highly cyclical earnings and with a high beta score, which is going to help you identify whether you're putting your investments into the types of companies that will grow and give you a high return on your investment during a period of economic growth. Then when we're looking at companies in the defensive sector, so here is a utilities company. If we scroll down and look at the beta score, this is 0.49%, which essentially means for every 1% move in the S&P 500, this company's stock is only going to move by 0.5%. So you can clearly see that companies in the defensive sector, their earnings have low sensitivity to the economic environment. And if I show you the actual performance of these exact two stocks that we've just covered, here is a defensive stock that's only up 5.65% in the first 6 months of 2026. And the first stock, which was a cyclical stock, which had high sensitivity with a beta score of 5, this company has gone up 331% in 6 months. So clearly you can see highly cyclical stocks give you outsized returns because we are currently in a phase of economic growth. And this is the type of relationship you can see with the earning sensitivity that drive the value of stocks compared to defensive companies. Now, fourthly, I'm going to show you how to use the macro dashboard inside of the app to identify the current economic environment. And this will translate directly into the sectors that you want to allocate your capital. So whether you are looking at defensive or cyclical stocks to weight your majority of investments into. Okay, so when you go through this macro dashboard, it literally tells you a summary of if we're going through economic growth. And at this moment in time, the growth indicators far outweigh the negative indicators. So when you track the macro data, this is going to tell you instantly, okay, I am going through a period now of economic growth. So we know in our portfolio, once you learn how to analyze the macro data dashboard, which gives you a summary of where the economy is going, you're going to know instantly, perfect. I know I need to be weighted towards cyclical stocks if we're going through economic growth. And if the data starts to point towards a slowdown in the economy, so the data starts to show you negative readings, you will know that you need to rotate, or you need to maybe take profits off the table and reduce your holdings. So the macro dashboard is the key, is the gateway into understanding whether you are weighted towards cyclical or defensive sectors. So the stock market is divided into 11 sectors. We have the energy sector, we have the materials sector, we have the industrials sector, consumer discretionary sector, communication services, information technology, known as tech, and then we have financials. And then we have the defensive sectors, consumer staples, healthcare, real estate, and utilities. Now, companies will either fall into being cyclical companies or defensive companies, as I outlined earlier. So when we're looking at the cyclical companies, all right, these companies are businesses whose revenues and earnings rise or fall with economic growth. So when the economy is strong and consumer spending is increasing, these businesses, their revenues expand. And that's because capital is freely flowing throughout the economy. Credit conditions are loose enough to encourage consumer spending. And these cyclical companies benefit enormously from economic growth. Okay, so their revenues rise, their margins expand, and their earnings accelerate. And the stock market, which is always pricing in the future expectations of earnings, they are investing into these cyclical companies heavily during periods of economic growth. So if you look at like the technology sector, it's driven by corporate and consumer spending on innovation. Think Apple, think any tech company, okay? And then we have consumer discretionary companies. And their earnings are driven by consumer confidence and spending when people are confident about their future, so they have disposable income. Then we have companies in the financial sector. So we're talking about banks here. And their earnings are driven by credit growth, lending activity, and that's always going to be driven by economic expansion. Then we have the industrial sector, and their earnings are driven by investment and infrastructure spending. Then we have energy and materials driven by demand from a growing global economy. And then we have the communication services driven by advertising spending and consumer engagement. So essentially, when the economy is expanding, these sectors lead. And when the economy is contracting, these are the sectors that fall the hardest. Hence why I was talking about the rotation in capital depending on the economic cycle and the environment we're investing in, which is why I was saying that the macro dashboard is the key indicator which tells you what is likely to happen next. And investors are using the macro data to position themselves based on the expectations of economic growth and corporate earnings. Now, the companies that fall into the defensive sectors, these companies are fundamentally different to the cyclical companies. Their products and services are necessities. Okay, so think about it like this. They're not luxury items, they're not discretionary purchases. So these companies are providing goods and services that people need regardless of the economic conditions. So companies that fall into, for an example, healthcare. When people get sick in a recession, the demand for medicine, hospital services, or medical devices, that doesn't disappear, regardless whether the economy slows. Same with consumer staples. Think about it. These are companies that sell food, cleaning products, personal care. Supermarket shelves are stocked in recessions, regardless of the economic environment. Whether we're going through economic growth or contraction, you're still going to buy your groceries. Then you have companies that fall into the utilities sector. These are companies that provide electricity, gas, water. And just think about it. People are going to pay their monthly bills regardless of the economic environment. Then we have companies that fall into the real estate sector. So essentially, infrastructure that provides stable And regular income, for an example, companies that are investing in building new homes, or companies that are collecting rents, again, their earnings are going to be far less sensitive to whether the economy is going up or down, because everybody pays their rent. So these companies in the defensive sectors, their earnings don't boom during economic environments, which is why when I showed you the stock that had a beta of 0.5, it's because their earnings are more predictable. So there's less demand for these companies because their value in the shares are not going up as aggressively as the cyclical companies, because their earnings are not rising as sharply or declining as sharply as the cyclical stocks. So think about it like this. Defensive companies, they hold their earnings. They fall less during an economic contraction, and they actually recover a lot faster than the cyclical companies. And they dramatically outperform in times of an economic contraction, which is why I was talking to you about the rotation between sectors whenever the economic environment changes, which is exactly why investors will position their portfolios in the defensive sectors during a time of an economic slowdown. Now, here's the cause and effect chain reaction that connects the macro environment to your portfolio. So when we're in an economic growth environment, which is exactly what our macro dashboard is telling us, we have more indicators pointing towards growth and expansion. And it tells you this in the summary: the majority of growth indicators are pointing towards expansion, suggesting the economy is currently in a growth phase. So we can see the business surveys, the manufacturing and the services PMI, they're indicating an expansion. And if I scroll down and show you these charts, they literally predict exactly the returns of the stock market. So you can see the S&P 500 yearly returns compared to the manufacturing PMI report. It literally tells you where the stock market is going. It's unbelievable. Okay. The business confidence of the consumer confidence reading is actually improving. It was depressed recently, but that was because of the war between the US and Iran, and we had that massive spike in oil prices. But recent numbers have started to improve. So consumer confidence is back rising. Small business optimism right now is in an expansionary phase, and there are millions of small businesses in the United States when we're looking at this macro reading. And it basically implies currently an economic growth environment, and the S&P 500 returns are in a positive expansionary score on our macro data dashboard. So corporate earnings across the markets are expected to expand in this environment. So cyclical sectors are going to be the primary beneficiary of this type of growing economy. We just have to remember, earnings growth in a growing economy is the most pronounced in the companies that are mostly sensitive in their earnings to that economic growth. So technology companies will see rising corporate IT spending, so their earnings are going to grow. We have consumer discretionary companies that are going to see rising household spending, so their earnings are going to grow. We have financial companies, so think about banks, they're going to be expanding credit because there's lots of transactions in the economy, so they're going to be lending more money in that environment. Industrial companies, for an example, they're going to see an increase in business investment, so their earnings are going to grow. Then you have energy and material companies. They're going to see rising demand for commodities like oil in a growing global economy. So your portfolio in a growth environment should be weighted towards cyclical sectors, because as we explained, their earnings are highly sensitive to a growing economy. Okay, so their earnings are going to be the ones that grow the fastest between cyclical companies and defensive companies. So in a growth environment, the cyclical stock prices are going to outperform more strongly than cyclical stocks. Now, in a macro slowdown environment, when there's a contraction in economic growth, you would see the macro data starting to deteriorate. So you may start to see business surveys in the manufacturing and the services start to contract, okay? And you'll start seeing contraction signals in your macro dashboard. And this is why when I show you the chart here, you can see the manufacturing is in orange. And as it starts to decline in the data, you'll start to see the S&P 500, which may be going up by 36%, for an example, it will start to fall. And you may start seeing returns of 16%, 5%, okay, 10%, whatever. And this is because these surveys are literally telling you from the purchasing managers at some of the biggest companies in the manufacturing sector, or companies that are providing services. They're literally telling you in real time, we're seeing our orders decline, we're seeing production decline, we may have to start letting go of workers. So these macro signals are early indicators that there's going to be an economic slowdown, and then investors start to rotate away from these cyclical stocks, because these very important readings for this macro data that comes out every single month literally tells you ahead of time what is coming in the macro environment. So you usually see during a period of a manufacturing slowdown and a services slowdown, you'll start to see consumer confidence start to contract at the same time. So when you have all of these major indicators starting to contract, you already know what's going to happen. Corporate earnings are going to start to be revised lower. And in this environment, animal spirits, so the confidence of investors, are going to reverse completely. So the cyclical sectors that were soaring during a phase of economic growth, now they're going to face a decline in their earnings. So the same companies that benefited the most from economic growth are now going to be hurt the most from an economic contraction. Because remember, it's earnings that drive the value of stocks. So a portfolio that served you very well in a growth phase will now start to work against you. And this is where the defensive rotation becomes critical. So as healthcare, consumer staples, and utility companies, as they maintain their earnings, because as we've seen, they're less sensitive to the economic environment, investors are going to rotate into these types of stocks. Okay, so in a market where the cyclical stocks may be declining by 10, 15, maybe even 20%, depending on how sharp the economic contraction is, a defensive company that's earnings are far more stable, they may only fall by 5%. So they're going to outperform the cyclical stocks. So your portfolio in a contractionary environment should rotate heavily into defensive sectors. And there are other instruments you can also invest into, like government bonds, which is beyond the scope of this video, but this is another rotation strategy that you can do. And it's not because they are going to generate, as I said, absolute blowout numbers in their earnings, okay? It's just because on a risk-adjusted return, they're going to perform better in a macroeconomic slowdown environment. So you can see that the macro framework is pretty simple. It tells you instantly how to match your sector positioning based on what the macro data is telling you about where the economy is going. So again, in a growth environment, you lean cyclical. In a contraction environment, you lean defensive. And you must transition between the two to balance your portfolio. Now, here's the beta tool that takes this from a general principle to a precise, quantifiable framework. So as we mentioned earlier, beta is simply a measure of a company's earnings sensitivity to the underlying economy and the market movements. So at the macro level, when we are seeing a period of economic growth or even an economic contraction, calculating the expected volatility of the stock that you're investing into is quite straightforward. So again, beta just compares how much a stock, all right, is sensitive to broader market moves. So when I showed you the beta was showing you the difference between a stock's sensitivity versus the S&P 500, which is the US major stock market benchmark, and that benchmark moves based on the economy. Okay, so for an example, a beta score of 1, it just simply means if the stock market rises by 10%, then this stock should, on theory, go up by around 10%. And if the market falls by 10%, well, then we would expect this stock to fall by around 10%. Now, beta is not an exact calculation where you're going to say, right, I don't really want to buy this stock because it's only got a beta of 1. It's just showing you some statistical data on the stock's sensitivity to the general market. It can go up by more than the general market, but it's just a good basis to kind of analyze companies and compare apples to apples, so you can start to determine whether you want to buy one stock or another stock. Because the stock below, we can see the beta score of 3.2 means that if the S&P 500 moves by 10%, well, then this stock should go up by around 32%. Okay, but we have to remember this is in both directions. So in a growth environment, we could see a 32% rise in this stock's value if the stock market goes up by, say, 10%. However, this also applies to a downturn in the economy. So if the stock market goes down by 10%, this stock could also go down by 32%. So again, you're looking at companies on a relative basis and identifying which companies are more cyclical than other companies based on the beta score, because it's telling you how sensitive their earnings are to the economic environment. And if we're looking at stocks with a beta score of, say, 0.82, okay, this basically means that this stock is going to move less historically than the actual market based on its beta. So again, if the stock market goes up by 10%, well, then this stock may go up by 8%. Or if the stock market falls by 10%, then this stock may go down by only 8%. So this obviously allows you to see the types of cyclical companies that are highly cyclical. So you may make much greater returns if you invest into them compared to other companies. And if you're looking at a defensive sector, you may decide to go into certain stocks which have lower beta than the general market because they're going to protect you during a time of economic contraction. So beta basically gives you a precise statistical way of measuring what the cyclical and defensive classification describes conceptually when you're looking at different types of companies. So instead of just simply categorizing one sector as cyclical or defensive, you can literally identify the exact level of earning sensitivity for any company. So for an example, if we're in the technology sector right now, if we are looking at a company with a beta of 2, it's far more cyclical and sensitive in their earnings to another technology company which has a beta score of 1.2. And if we're looking at a healthcare company with a beta score of 0.4, for an example, it's far more defensive and safe to invest into in an economic downturn than a healthcare company which has a beta score of, let's say, 0.8. So beta allows you to fine-tune your positioning within sectors, not just between them. So in a strong economic growth environment, you want cyclical exposure. So you're going to tilt towards companies with high beta cyclical scores, okay? Because this is going to maximize your participation in the upside of a growing economy. And let's say we're in an economic contraction environment. You want to play defensive and really be selective in your positioning so your portfolio holds its value during an economic downturn. So you're obviously going to tilt towards companies with a lower beta score than other companies with a higher beta score to basically minimize your downturn. So inside the macro portfolio app, beta is displayed for every single asset you analyze. Okay, so you don't have to calculate this and work it out manually. It's right there in front of you, instantly visible for every stock, ETF, or fund that you build in your portfolio. I used to have to use Excel spreadsheets, and this would take me hours, sometimes even days, to go through a sector. This is now done instantly. So this really does move the needle and enabling you to pick the type of investments that you want fast without having to delay, second guess, and worrying if you're making the right decision. You know exactly what you're getting into when you're investing in specific companies. So when you start to build a portfolio, which is what you'll be able to do inside of the macro app, this allows you to basically put a bunch of positions together. So I'm in certain cyclical sectors, I'm in some commodities, I'm in gold, for an example, I'm in some treasuries, and I can analyze my portfolio's beta. So my portfolio right now has a beta score of 0.85, which means my portfolio is less sensitive to the market. Okay, so I'm taking less risk, but my portfolio actually generates much higher returns than the market. So on a risk adjusted basis, this portfolio that I've built is powerful because the S&P 500, which is the benchmark, the average returns around 14.9%. My portfolio is generating 20% returns a year. And I've backtested this for 10 years. Okay. And this is powerful because you can literally see how your portfolio performs compared to the S&P 500 year after year. So you can see that over the long period of time, my portfolio is outperforming the general stock market, but I'm taking less risk. So if you can position a portfolio with low beta but higher returns, now this is where the game of investing is won, because essentially you're able to make and build a portfolio that gives you higher returns for less risk. And then if you can rotate during the periods of economic downturns, then you're going to massively outperform. Okay, so let's now bring this whole framework together, because we have to remember the framework is only as good as the macro data driving it. Okay, and the data tells you which kind of environment you're currently in. And this is exactly what the macro dashboard inside the app is built to show you instantly. Okay, so let me walk you through how to connect all the pieces of the puzzle together. So you come into the macro dashboard, okay, and it tracks the key leading economic indicators that predict the economic conditions 6 to 12 months ahead. All right, so when I showed you the manufacturing and the services PMI reports, these are the most reliable economic indicators that predict GDP growth with an 85% certainty. So when I showed you this chart and I show you that the manufacturing report is above the level of 50, as an example, this means the economy is expanding. Okay, and if the economy is expanding, cyclical sectors are highly favored, which is why you start to see the stock market going up by 15%, 20%, 30%. And then when the manufacturing sector data starts to decline and it goes below the level of 50, you start to see the S&P 500, for an example, and cyclical sectors start to contract, because the survey is literally telling you in real time that the economy is going to contract in the next 6 to 12 months. Okay, so this is why the cyclical sectors start to get heavily sold off by investors. And this is when the defensive sectors are highly favored. Okay, and if we look at the consumer confidence, you can see that economic growth is driven by consumers, right? Because what we have to understand is that consumer confidence surveys literally tell you in real time whether households and human animal spirits, they feel confident or cautious or scared about their future economic prospects. So if consumer confidence is rising, okay, then that essentially means consumers are going to spend money because they're confident about the future. So cyclical stocks in this environment are going to perform very well. So think of like technology companies, for an example, they're going to benefit in this environment. And if the consumer confidence data starts to deteriorate, consumer spending is going to contract because consumers are fearful about the future. And this is when the defensive sectors are going to come into high demand. So think utilities companies, they're going to be the preferred allocation for investors to put their money during a period of consumer confidence deteriorating. And this is why you see the GDP growth start to turn negative. It literally tells you in real time what's coming. Then, for an example, we may look at interest rate expectations by a central bank. Now, this is crucial because what interest rates basically tell you is is consumer spending going to be forced by the central bank raising interest rates to contract? Because consumers have to spend interest payments on their mortgages, credit cards, car loans, student debt payments. So when interest rates are going up, this can tell you that maybe the economy is going to start to slow down. And another really important indicator that literally tells you this in real time is the yield curve. Now, the yield curve is incredible. It's literally predicted every recession in the United States for the past 50 years, every single time. So a normal upward sloping yield curve basically tells you that there's a growing economy expected into the future, which is why bonds that investors buy over longer periods of time, investors are basically demanding higher levels of interest to borrow money for longer because they don't know where the level of inflation is going to be in the future. So a normal yield curve like this instantly tells you we're in an economic growth environment. And an inverted yield curve, you would see actually interest rates on the short end of bonds paying more interest than interest paid on the long end of bonds. And this is beyond the scope of this video. I've actually got a full video on my YouTube on this. An inverted yield curve literally tells you a recession's coming. There's going to be a slowdown in economic growth. So you know investors are going to rotate instantly into the defensive sectors. So what we have to look at is at the top here, the macro data dashboard literally tells you all of these signals and it gives you a clear read on the economic environment. So is the data signaling an economic expansion? Well, if it is, then economic growth is expected. And that means that the earnings of companies are going to be growing. Okay, so we know where we're going to be investing into more heavily. Cyclicals. Or is the macro dashboard pointing towards an economic slowdown? So is the economy slowing down, or maybe is it actually going to start to contract? And these signals will tell you if we're going to go through economic growth, or maybe if the probability of recession is rising. So each of these environments has a direct implication on where you select and you allocate where to put your capital inside of the environment that we're showing you. So what you'll see is when you're looking at the macro data dashboard in a growth environment, you're going to see more green on our scorecard. Okay. And this is basically telling you that the business surveys are expanding, consumer confidence is rising. Let's say the yield curve is steepening and looking normal. So this is the signal that weights your portfolio towards cyclical and high beta stocks in the cyclical sectors. So you may say, okay, I'm going to go have a look at technology companies, consumer discretionary, financials, industrials, companies that are in the energy sector, because we know that these companies are going to benefit the most during a period of economic growth, which is predicted to play out over the next 6 to 12 months. However, if we start to see a lot of amber scores on the dashboard, okay, we know, okay, growth is cooling. Maybe the business surveys are starting to soften. Maybe consumer confidence is starting to deteriorate, okay, or just come lower. And this signals maybe there's going to start to be a rotation in capital, because remember, the investors are using the macro data to know what's coming with economic growth, and stocks go up or down based on the underlying performance of a country's economy. So you may want to be reducing your high beta cyclical stocks during this period of amber and an economic slowdown. And you want to maybe start adding some defensive exposure. So going into the healthcare sector, consumer staples, or utilities. So you're trying to balance the portfolio to prepare for a potential deterioration in conditions. Okay. Now, if we have a lot of red scores on our macro data dashboard, it's going to be showing here, you're going to see a lot of red. Okay. And basically this is when the business surveys are below 50 and falling, consumer confidence is getting very weak, the yield curve is inverted, and this signals that you need to be going into the defensive sectors quickly, especially into the low beta companies whose earnings are more resilient in a downturn. Okay. And this will be the difference between everyone else watching their cyclical portfolio blow up in front of their face and you being protected. Okay. Because you have access to a macro data dashboard that tells you what's coming. A lot of people don't have this information and have access to this type of macro data, and they don't understand how to interpret it. Okay, and then when the data dashboard starts to turn positive again, well then great, you know when to rotate back into cyclicals. And you know when to get into stocks just as they start to recover. So you'll get big gains in your portfolio. But you'll be doing it at the right time because the macro data is telling you what's about to happen. So you're predicting and positioning ahead of the move and you're not reacting after it. So if I was to just basically complete the framework in one simple sequence, the macro data dashboard reads the economic environment. The economic environment determines whether you lean towards cyclical stocks or defensive stocks. The beta score tells you exactly how sensitive a company's earnings are to the environment that you're analyzing. And the portfolio builder that I showed you earlier, okay, this literally allows you to construct a portfolio in the right sectors with the right weightings and creating a portfolio that's going to outperform other portfolios where people have no idea what they're doing. So you're not guessing, you're not hoping, you're simply following a rules-based, data-driven system that tells you exactly what to do, okay, and the types of companies you want to own and why. And it tells you this instantly, every single month. So what I'm showing you is exactly how professional investors build portfolios and rotate capital depending on the economic environment and the economic cycle we are going through. That's the framework. So just to wrap this up, what I've shown you today is honestly one of the most powerful principles in investing. The relationship between the economic cycle, sector sensitivity, and portfolio positioning and construction. Understanding which type of company you want to own and when is not a secondary consideration. It is a primary driver of your portfolio performance over market cycles. And the macro data dashboard inside the app literally gives you the economic signals before they even come into play. Okay. Again, the beta gives you the sensitivity of the earnings and it measures it for you. So you know which companies you want to be investing into. The portfolio builder gives you the tool to construct a portfolio to your desired level of risk and the type of return you want to make. So you could literally build a portfolio that makes you 10% return with 10% risk. Some of you may want a 25% return portfolio with 20% risk. So you can build a portfolio to your desired comfortable levels of risk and the returns that you want to see in your portfolio. Instead of doing weeks of manual research, which I've had to do, I used to have to do this on spreadsheets and it would take hours, days, and it was very frustrating. I used to get put off by doing it because it just took up so much time, like literally manually putting this into spreadsheets. But now this is done in minutes, saving you so much time. Okay, because the investors who get this right don't spend more time researching. They actually spend less time when you've got an AI data-driven tool that can do it for you in minutes. Okay, because if you have the framework and you have the tools to apply it, you're going to get the results. Now, the full framework for you to really learn how to read every indicator inside the macro dashboard, okay, and how to interpret the economic cycle signals and how to translate this into precise sector positioning is all covered inside my completely free macro training. So literally, guys, come over to macromarkets.co.uk and enjoy a full free training on this framework. And if this is something which you would like to use to build your own portfolios after you watch the video, book in a call with me and we can look at your specific situation, what assets you may be currently holding, or whether you are just starting out from scratch. I would love to help you and serve you. I really do hope this video added some value, and hopefully I'll be serving you shortly, working on your portfolio and hearing from you soon. Thank you, guys.